Today is March 27th, 2026, and Robinhood Market stock, ticker HOOD, had a rough day. The stock dropped 6.15% during regular trading hours and fell another 0.71% in after-hours trading, closing right around the $66 level. This comes after a period of intense volatility and a very sharp reversal from its highs earlier this year. So, what exactly is going on here? Why did the stock drop so much today, and what should investors be thinking right now? Let's break it all down. First, let's talk about why HOOD fell today and how the stock has been performing recently. There are a few key reasons behind today's sell-off. One of the biggest factors is analyst downgrades. Several firms, including Mizuho and data aggregated by platforms like MarketBeat, have lowered their price targets. The main concern is that Robinhood's revenue base is still heavily tied to high-risk and volatile trading activity, especially in crypto and options. That kind of revenue can swing dramatically depending on market sentiment, and right now, sentiment is weakening. Another issue is skepticism around the company's newly announced $1.5 billion share buyback program. Normally, buybacks are seen as bullish, but in this case, the market wasn't impressed. Investors are more concerned about the fundamentals, especially the fact that crypto transaction revenue has dropped roughly 38% year over year. That's a major red flag for a company that benefited heavily from crypto trading booms. On top of that, macro conditions didn't help. A hotter-than-expected inflation report and ongoing geopolitical tensions, including the Iran conflict, have put pressure on the broader market. We've now seen about a 5-week skid across major indices, and high-growth fintech names like Robinhood tend to get hit harder in this kind of environment. Now, looking at recent performance, the contrast is pretty dramatic. In 2025, HOOD was absolutely on fire, with the stock surging over 200% thanks to strong earnings growth and a resurgence in crypto trading. But in 2026, the story has flipped. Year-to-date, the stock is down roughly 41% as of today. That's a massive drawdown and shows just how volatile this name can be. Next, let's quickly go over what Robinhood actually does. Robinhood is a fintech company that operates a mobile-first brokerage platform. It allows users to trade stocks, ETFs, options, and cryptocurrencies with zero commissions, which is what originally made it so popular. The company makes money in a few main ways. The first is payment for order flow, or PFOF, where market makers pay Robinhood to route user trades to them. The second is net interest income, which comes from uninvested cash in user accounts and margin lending. And the third is subscriptions, mainly through Robinhood Gold, which costs about $5 per month and offers perks like higher interest rates and advanced research tools. Recently, the company has also been expanding into new areas. These include prediction markets, also known as event contracts, and even launching a gold credit card. They're clearly trying to diversify beyond just trading revenue. Now, let's talk about analyst price targets. Despite the recent sell-off, analysts are still somewhat optimistic overall, but opinions are divided. The average 12-month price target is around $122, which suggests significant upside from current levels. The high estimate goes as far as $180, while the low end is closer to $88. Looking further out, some long-term models suggest that if Robinhood successfully executes on its expansion strategy, the stock could reach somewhere between $190 and $215 by the end of the decade. But of course, those projections depend heavily on sustained growth and diversification. Next, let's look at valuation, because this is where things get a bit tricky. Right now, HOOD is trading at a price-to-earnings ratio of about 36 times. That's not cheap, especially for a company with highly volatile revenue streams. On a price-to-tangible book basis, the stock is trading at around 12 times, which is significantly higher than traditional brokerage firms like Charles Schwab, which trades closer to 7 to 8 times. Another concern is growth deceleration. In 2025, revenue grew about 53%, which is very strong. But in 2026, that growth is expected to slow down to around 22%. When growth slows but valuation remains high, that creates pressure on the stock multiple. So the big question, is HOOD still a buy? The answer really depends on your risk tolerance. On the bullish side, many analysts still rate the stock as a strong buy. About 14 out of 22 analysts maintain positive ratings, pointing to strong recent revenue, which was around $1.27 billion, and very rapid earnings growth in recent quarters. But on the bearish side, there are real concerns. Some analysts believe the stock could continue to decline through 2026, arguing that it's still not cheap and that much of the optimism, including potential inclusion in major indices, may already be priced in. Now, let's talk about the risks, because there are quite a few. One of the biggest risks is crypto dependency. A meaningful portion of Robinhood's growth has been tied to crypto trading activity, and we've recently seen volumes drop by more than 50%. If crypto remains weak, that could continue to drag on revenue. Another major risk is regulatory scrutiny. Payment for order flow has been under the microscope for years, and any changes to regulations could directly impact one of Robinhood's core revenue streams. On top of that, newer areas like prediction markets could also face regulatory hurdles. Margin compression is another issue. Even though revenue has increased, net income margins have declined from about 50% to roughly 42% in early 2026. That suggests rising costs or less efficient monetization, which is not ideal. Finally, here are a few additional things investors should keep in mind. We're starting to see some institutional investors de-risk and rotate out of high-valuation fintech names, including Robinhood. That kind of selling pressure can weigh on the stock in the short term. At the same time, the company is pushing for global expansion. The acquisition of Bitstamp and expansion into markets like the UK and Europe could help diversify revenue away from the US retail trading cycle. If executed well, that could be a long-term positive. So to wrap it all up, Robinhood is a high-growth but high-risk stock. It has strong momentum in the past, innovative products, and a large user base, but it also faces real challenges, including revenue volatility, regulatory risk, and a still premium valuation. If you're a long-term investor who believes in the company's ability to diversify and grow beyond trading, this pullback might look like an opportunity. But if you're more risk-averse, the volatility and uncertainty might be a reason to stay cautious. Thank you so much for watching. If you found this breakdown helpful, make sure to like the video and subscribe to the channel for more stock analysis and market updates.